So you've watched the news. You've seen that the CBK has declared more interest cut rates. And you're there wondering, so now what happens to the money that you had put in your money market fund? Or the money that you had invested in your treasury bills and treasury bonds? Because now it's not going to give you as high interest rates as you had hoped for. If those are the questions that are in your mind, come along with me throughout this video to learn of alternative investments that you can take. Hi guys, long time no face, but I'm sorry, I'm back now. Now let's get back to business as usual. If you've been taking your financial literacy journey seriously, and you've been watching business news or reading business newsletters as we spoke during our previous videos, then you know that the government interest rates have been at an all-time low since 2019. Okay, so we are at a period where we're likely to start seeing rates as low as 6% or even 8% on your money markets, on your treasury bills and your treasury bonds. And so if your goal is to make sure that you create wealth or you get your money to work for you, then you know for sure that at this current moment, having your money in your money markets or investing in treasury bills and bonds is not going to give you the desired returns. And so you're probably wondering, what other alternatives can you take? That's why we're here on this video today. So first things first, I want us to understand that there is an inverse relationship between equity and bonds. That means that when one is performing well, the other one is not doing very well. And because right now the bills and bonds are really not doing well, that then means that the equities are performing really well. Actually, as of Friday, the Nairobi Stock Exchange had actually performed really well again. It was the best performance that it has had in the last 5, 6, 7 years, all right? And this is because now most people are moving their money from the treasury bills and bonds or even money markets into the equities. And so you're here, you're a beginner and you're wondering, if you want to invest in equities, what do you do? Or if you want to invest in the stock market, then what do you do? I'm going to do this like I'm doing it for a beginner. So if you are new and you don't know what a stock market is, basically a stock market is an electronic marketplace, all right, that allows people to buy and to sell shares. For ease of reference, when I talk of an electronic marketplace, I mean something like Jumia. Let me use Jumia because I'm sure some of us are well conversant with that. So it's a place where you can go, you choose, for example, you want to buy shares for a company like Safaricom or Kengen or KCB, whatever company you're interested in. Just understand that the stock market is an electronic marketplace that will allow you to buy shares. What do we mean when we say you bought shares? Buying shares technically is buying part ownership in a company. That means, for example, if today you buy shares for KCB, for example, it means that you bought part ownership in KCB. What happens when you're buying ownership in a company or when you are an owner of a company? It means that when that company makes profits, then you get to share in it. And if you bought shares in a company, then that means what you're going to be getting are dividends. But also remember, this means that the company is making losses, you get to share in their losses. So if a company is making losses, then you do not get any return on your income, all right? So I hope that is clear when we talk of stock marketing investing, all right? And then there are two types of stock marketing investment. You can either invest for growth or you're investing for dividends. This is what I mean. When you're investing for growth is when you buy shares at a low price and then when they go high, you sell them, okay? This is a really short-term approach. While it may give you more returns, it is really not recommended for someone who's, just a beginner, because you probably don't understand the factors that are going to influence the price movements. You don't understand how to, read and understand the financial statements. But again, I keep saying I'll give my opinions based on the risk profile of individuals, and then based on your risk profile, you just know that if you take the short-term approach, you're more likely to lose your money more quickly, but also the the greater the risk, the greater the reward. Okay, so if you're doing growth investing, it's where you buy low, observe. When the shares go high, you sell, you take your margin, and go home. All right, like we said, that's a really short-term approach. But then when you do dividend investing, this is where you're investing for a long term. Okay, like for example, you can buy shares we're in 2025 and not sell them up until 2030, 2050. Maybe you're taking this as a retirement approach. Okay, so this means that then you're going to be getting dividends over time based on the shares that you've invested. Okay, and when you're starting off, because chances are you're not going to start off with a lot of money, then when you get your dividends, you don't even have to take them. You can actually decide to reinvest them back, so that you're growing the amount of shares that you've invested in. Okay, so if you're a beginner, this is the most preferred approach, because this then means you don't have to worry about the short-term price movements, because I can tell you for sure, price moves every day. Like you wake up in the morning, go to NSC, and for argument's sake, let me use KPLC. You bought KPLC shares. In the morning, they were trading for 7 bob. In the evening, they're trading for 6 shillings. So if you take the short approach, these price movements are going to give you a lot of stress, because you're going to be thinking that you're losing your money. So if you're a beginner, I'd highly recommend you take the long-term approach. Just invest, but before you invest, you need to do your proper research. Yeah, let it stay there. Just forget about it and use it as a retirement plan, so that it gives you money every other month, or not every other month, every other time the company is paying out dividends. Then you end up getting back your money in form of dividends. Okay, so first of all, those are the 2 steps. So now we understand what stock markets are, we understand the 2 types of investing. So now maybe the question is, if I need to invest in the stock markets, what do I need to do? The first and the most crucial step, which is also the most difficult step, is getting to choose a company. Because if there's one thing that could really mess you up, is maybe because maybe you went to TikTok and you saw someone saying, maybe buy shares for company ABC. You run and buy without even understanding how the company is performing, without understanding the financial statements of that company. You might end up losing your money because you're jumping on a bandwagon before understanding how these things actually operate. Okay, so the most important thing, or the most crucial part, is getting to decide the company in which you invest in. So how exactly do you understand a company? Remember, during the first videos I said, the same way it's a basic skill, to tie your shoelaces, it should be a basic skill for you to be able to read and understand the financial statements of a company. If you would like me to teach you, you can engage me down in the comment section below. But for now, in the YouTube University, TikTok University, this is information that you can freely get. You need to invest in a company that is growing, so that as the company is growing, your money is growing as well. Okay. Some of the other things that you need to check out for is, for example, debt. You need to invest. First of all, the way the Kenyan market is set up, yeah, there are very few companies. Actually, I don't think there's any company that operates without debt. But you need to actually check out for the debt ratios. Why am I saying this? Because at any given time, a company will pay out its debt first before it starts paying out dividends. So if you invest in a company that has a lot of debt, then that then means you're not going to be likely to get your dividends, because anytime they make profit, they prioritize paying the debtors first. I'm not saying debt is bad, but you need to understand the debt ratio of that company. Other things that you need to look out for is reputation, right? I know in the age of social media, there's a lot of false information that's likely to be spreading around, but that's why you need to watch out for business news. And I understand that watching news in Kenya right now is quite depressing, but then don't watch the main news, watch the business news. Okay, read those business newspapers. Nowadays you don't even need to buy the physical copy. You can just read online. You can read the journals, the business journals such as Business Daily, the Wall Street Journal. I can recommend some of the business new places where you can get the business news. You can engage me down here below if that's something you're interested in knowing. But this is where you get your information. Make sure you understand the company that you want to invest in. Don't just jump into something because someone told you to do it, okay? Because remember, it's your money, and investing or personal wealth or personal finance is a really personal journey. As much as we are here giving you advice and giving you pointers on what you may or may not do, at the end of the day, you get to decide where you want to invest, because if it is your money. If you lose it, it is your loss, okay? So that is the most difficult thing to do. But after you're done with that, the rest are just easy steps, okay? So step number 2 is getting a licensed broker. Because remember, you can't just trade shares by yourself. How do you get a licensed broker? You need to go into the NSE website, all right? When you go to the NSE website, at the end of this video, I'm going to show you what the NSE website looks like. It will show you a list of brokers that you can use. You get to choose for yourself. I cannot recommend that. But some of the things that you need to look out for: one is a broker who has an online platform that is working. Because in this day and age, who wants to be walking around with papers going to an office to get things signed for you? I mean, no one, right? So you need to ensure that they have an online platform where you can use, okay? Make sure the online platform is working, okay? The other thing that you need to look out for is brokerage fees. Because remember, these people are never going to do these things for free for you, all right? They're going to charge you around 1 to 3%. I personally think like 3% is really high, but if you get a broker that will charge you between 1 to 2, 2.3, 2.5%, that's quite reasonable, okay? So you also need to do your research on what the brokerage fees for the broker that you've taken are, okay? And then finally, you need to get into a broker that will not only give you a platform where you can invest, but a broker who will give you financial advice. What do I mean by financial advice? There's some brokerage firms that you will use that are likely to tell you maybe or this week, some of the shares that you can put on your watch list are maybe KCB or Safaricom. And you know, this is a firm that has people working on these things, so they understand the news, they know some of the things that can affect the price movement or whether or not you're going to make money. So yeah, that's the second step. So the first step is understanding the companies, okay? The second step is getting a broker. And finally, the third step is opening a CDSC account. This is basically an account. Again, for ease of reference, I like to use layman's language so that in case you're new to this investing journey and you really don't understand these things, it makes sense to you. When you have a CDSC account, it's just like having a bank account, you see, where you see if you get in your bank, you can actually see maybe on Monday or on 6th of January, I got 10K and then I spent 5K. If you've invested in like the money market, for example, if you're using a bank platform, for instance, it tells you the rate this week has been 8%, the rate this has been 10%, and so far this is the amount of money that you've made. So basically, a CDSC account is an account that will allow you to trade in shares. How do you open this? If you get a good broker, you don't even need to go to the bank to open this. They'll send you those forms, you'll fill them. It takes around 2 to 5 days for them to verify, you know, your KYC. Your KYC is basically something like your carrier PIN, your passport photo, your ID. Those are some of the things that are going to be required. And then once that it's done, you're set to go, okay? So come with me as I take you through what the NSE website looks like. And then after that, next week, we can start looking at some of the shares that you can have on your watch list. If you prefer the growth investing, there are some companies right now that have already declared the dividends, but for you to earn dividends at that particular time, there is something we call book closure date. Book closure date is, hypothetically speaking, if you buy shares of company ABC by say 30th of June, okay, then you qualify to get a dividend at a particular rate that they usually declare, maybe by 31st of August, okay? So that I do not confuse us, I wanted us to stop here for today. Engage me down below if there is something that you'd like to learn. But in our next video, we're going to be talking about the companies that have already declared dividends. So if you want to take the short-term approach, you can get in right now. Of course, you see when a company declares dividends, the shares are likely to go higher, you know. And then if you want to swipe on that, that's something you can work on. But also, we can start looking at some of the shares that you can invest in if you're actually interested. Okay, so watch with me this NAC video, and after that, remember our outro is always don't just sit there, do something. Okay, until next time, bye. So hi guys, as I had promised, I was going to show you what the NSC website looks like. So basically, just go to your browser and Google NSC website or look for NSC website. It's going to bring you here. Okay, and then this is basically the interface of the NSC. Okay, so here you see, you can get to see the investor relations, or you can get the reports, for example, the annual reports or financial reports, or even the strategies of the companies that you're interested in. Because remember, you need to get information. You can get here to see the press releases, because remember, some of the news that are made will actually determine how your shares perform. Okay, then this is where we are most interested in, because remember we said we need to get a licensed broker. All right, so you'll come to regulations, go to market participants. Okay, then look for trading participants. This will show you a list of all the registered or rather licensed brokers that you can use for you to be able to trade in the NSE. So choose one that works for you. Like I said, you need to have information, for example, on the brokerage fees, on whether or not they have an online platform that works, whether or not they give you financial advice. These are some of the things that we mentioned. Okay, yeah, you can also see there are so many other things that you can see from this platform, but for now you can familiarize yourself with it. But our assignment for this week is to just make sure you get a registered broker, so they'll open a CDSC account for you, and then we can start trading together. Okay,